A business can be profitable but could still ultimately fail if it doesn't have enough cash on hand to service its payables when they fall due, because what the payables will do is call their debts in, and that can cause liquidity crisis and can ultimately lead to bankruptcy of the organisation and therefore business failure. So as part of the budgeting exercise within the organisation, managers also need to be aware of how much cash they're going to have at certain times. So an important part of the budgeting process is to pull together the cash budget as well, and that's what we're going to consider throughout this chapter. So we're going to consider what cash budgets are and the way in which managers can use cash budgets. Ultimately, managers are looking for taking decisions on the cash in the business, financing any expected cash shortages, or investing any cash surpluses. So we'll start by considering what a cash budget actually is. Now, a cash budget looks at the cash elements of business transactions, and it differs from the profit or loss account or the income statement, because the income statement looks at transactions on an accruals basis regardless of when the cash is received or paid. So we can't just rely on the budgeted operating statement to look at the cash position of a business at all times. We need to pull together this separate cash budget that will tell us about the cash movements in the business and how much cash we're either going to have in excess at the end of the period or how much cash we're going to be short by at the end of the period. So a cash budget is a method of determining the expected net cash flow for a future period and the expected cash balance at the end of that future period. So the cash budget is trying to determine how much money we have at the end, whether we got a surplus of cash that we need to invest or a shortage of cash that we need to finance. Now, in order to neatly present this to management, we will put together a cash budget such as the one that we can see below. So what we do is we have the cash receipts at the top and therefore have all the cash inflows. We then take the cash payments and put them under those cash inflows. Now, if we subtract the cash receipts from the cash payments, we can see that we generate a net cash flow. Now, we need to compare that net cash flow to the opening and closing balances of our cash. And that will then foretell us whether at each of these months we will end up with a cash surplus or a cash shortage. The rest of the chapter is dedicated to two different approaches that we can take to pull together the cash budget. We can either use the operating budget that we've put together alongside changes in the statement of financial position balances to work out the cash effect of transaction movements and put those cash effects into our cash budget. Or we can use the operating budget and allow for time lags, such as receiving credit from suppliers and offering credit to our customers to pull together the cash budget. Both of those methods are in your budgeting syllabus, and both of those methods can be assessed in your assessments. However, using the operating budget and the changes in statements of financial position balances is often the most common method that the budgeting assessment takes to pulling together the cash budget. So that's where we'll start, how to use the operating budget and the statements of financial position assumptions to pull together the overall cash budget. Now, this method separates the time period when we incur the cost or we earn the revenue from the time period when we actually pay the cash or receive the cash in. There's likely to be a delay between the two, especially if we are making purchases on credit or we're making sales on credit. It therefore means that the sales figures that we've got in the operating budget don't necessarily represent the cash movements in and out of the business. So, for example, sales recorded will not usually equal cash received for the month because we're going to have a mixture of both cash sales and sales on credit. And as we've just discussed, the sales on credit, the money from those sales are going to be received in later than the time period in which we record the sales revenue being earned. So that means some cash will not be received until after the month that the sale has occurred. So from a cash budget perspective, we need to be aware of that and record the cash coming in the time period when that cash is actually going to be received. Now, a simple way of trying to calculate the cash effect of our sales is to adjust the sales figure that's stated in the operating budget by the change in the receivables balance. We can also do the same for any credit purchases. We can adjust the purchases figure on the operating budget by the change in the payables balance. Illustration 1 demonstrates how we can work out the cash effect of transactions using balances brought and carried forward on the statement of financial position alongside sales and purchases information given to us on the operating budget. So let's start with receivables. For a business, the receivables brought forward on the statement of financial position was £450. But at the end of the year, that receivables balance, the balance that we've carried forward onto the statement of financial position, is £500. On our operating budget, we have recorded sales of £1,200. So during the period, the logic is that we would receive all of the balances outstanding at the start. So we would receive all of the £450 brought forward. We would also receive all of the sales revenue that is recorded on the operating budget, so all of that £1,200, but we would not have received £500 that we carry forward on the statement of financial position because we haven't yet got the balance in. The customer still has that money. So if we add the sales from the operating budget to the receivables brought forward and subtracts off the receivables carried forward, we end up with the amount of cash that we received in respect of sales. In this instance, £1,150. Alternatively, what we could do is we could adjust the sales recorded on the operating budget for the movement in the receivables balances. We can see that during the year, the receivables balance has increased by £50. And of course, we are recording £1,200 worth of sales on our operating budget. Now, because the receivables have gone up during the periods, it means that we would have received into the business £50 less than is recorded on the operating budget. So if we subtract that £50 from the £1,200 that we've recorded on the operating budget, we've ended up receiving in £1,150 as cash from sales. We can take the same approach by working out the cash that we paid out for purchases and other payables. So on our statement of financial position, we had a payables brought forward balance of £340 and a payables carried forward balance of £320. And we've recorded purchases on our operating budget of £760. Just like the sales and receivables figures, the logic is that we would have paid all of the opening balance and all of the purchases cost recorded on the operating budget, but we haven't paid the balances outstanding. We've retained our cash. So if we add 340 to 760 and then subtract off that payables balance carried forward of 320, we can see that we've paid the equivalent of £780 in cash in respect of our purchases. We can more simply get to the same answer by taking the purchases that have been expressed on the operating budget and adjusting for the decrease in the payables balance during the year. So if we take a look at the balances brought and carried forward, we can see that it has decreased by £20 during the year, which essentially means that we've paid out £20 more for our purchases than has been recorded on our operating budget. So if we add on £20 to the £760 that has been recorded on the operating budget, we come up with the same answer. The cash paid in respect to purchases is £780. We can summarize what's happening in illustration 1 by looking at what happens if those balances increases and the subsequent impact on the cash either received in or paid out by the business. So if any of those balances increases, this is going to be the effect on the cash flows. If we have an increase in the receivables balance, we are receiving less cash into the business, and therefore the business generates a lower cash inflow. Now, this is because the customers have got hold of our money. They haven't yet paid us our money. So if we've got the balance going up, the customers have more of our money, meaning that we generated a lower cash inflow. If our payables balance increases, that means we've paid out less cash from the business, and therefore the business overall generates a lower cash outflow. Now, this is because we haven't yet paid the supplier their money yet. We've still got use of our own money. So it means that the money we've got in the business is higher and the cash paid out is therefore lower. We can do the same with inventory. Now, if inventory balances increases, it means the business has not yet sold the goods and therefore has not yet received the revenue from those sales. And the result of that is a lower cash inflow. Purely because the sales volumes have gone down, we haven't generated the sales revenue yet. Now, understanding the movement in the balances and the subsequent impact on cash flows is the most common way in which cash budgets are tested in your assessment. So you must make sure that you're happy with the theory and make sure you practice lots of tasks within this area to make sure you're fully prepared for the assessment. Illustration 2 demonstrates the approach to pulling together the cash budget if we are told information about the increases and decreases of receivables, payables, and inventory. So here we got Terra Limited, and they're putting together their cash budget for the forthcoming period, and we're going to calculate the expected cash flow for Terra for this period. We're given an operating budget which tells us about sales revenue, expenditure on materials, labour and other costs, and therefore the forecast operating profits on the budget. We're also told that receivables are going to increase by £1,100, that payables for materials are going to decrease by £800, that labour costs are paid in the period in which they're incurred, and that other payables are going to increase by £350. Now, to work out the cash budget, we need to understand the impact that those change of balances is going to have on the cash received or paid by Terra in this instance. So if we take receivables to start with, now we are told that receivables have increased. It means, therefore, that we have not collected £1,100 of cash from our customers. It ultimately means that the customers have the benefit in this instance of Terra's cash, and Terra themselves don't. So because of that, it means that the cash inflow from sales revenue is going to be lower than the sales revenue stated on the budgeted operating statement. So what we do to work out the cash inflow from sales is we take our sales revenue from the operating budget, £22,000, and we subtract off the cash not yet collected from customers, £1,100. It therefore generates a total cash inflow related to sales revenue of £20,900. Now let's take the same approach for those materials costs now. So what we're told with materials is we've budgeted materials costs to be £5,600, and we're told that material payables will decrease by £800. So because those materials have decreased, we have paid £800 more cash over to suppliers than the expenditure on the operating budget suggests. So once again, appreciate who's got the money in this instance. It's not Terra that's got the money, it's the supplier. We have paid over £800 more. So that's going to make the cash in outflow from materials higher than the materials cost on the operating budget. So to calculate the cash outflow from materials, we take the £5,600 expenditure on the operating budget. We're going to add on the additional £800 paid over to suppliers. So that means our total cash outflow from materials is £6,400. So now let's go on to labour. So on the operating budget, we're told the labour expenditure is budgeted to be £9,500. And in the bullet points, the third bullet point says that labour costs are paid in the period in which they are incurred. So because labour is paid in the same month that the cost is incurred, and no balances are held for labour, it makes the cash outflow from labour the same as the cost stated on the operating budget. So what we're going to do is show cash outflow from labour 9,500. So no balances, there are no payables, we pay labour as it's incurred in the month. So we pay the same amount of expense, and therefore we take the expense on the operating budget and put that as a cash outflow on the cash budget. Next is to work out the cash outflow from other costs. So we've calculated other costs on the operating budget to be 3,800, and the fourth bullet point down says that other payables will increase by £350, and those other payables are going to relate to other costs. Now this time we got a situation where those payables have increased and they've gone up by £350. And that ultimately means that Terra has not yet paid those suppliers. Again, once again, just appreciate who has actually got the money. Is it Terra or is it the suppliers? Well, in this situation, it's Terra, because we have not yet paid over £350 to our suppliers. We've still got the benefit of our cash. And it therefore makes the cash outflow from other costs lower than that stated on the operating budget. So to work out the cash outflow from other costs, we take the other costs per the operating budget of 3,800. We're going to subtract off the cash not yet paid to suppliers of 350, which makes the cash outflow from other costs 3,450. So now what we do is we now pull all of that together into the cash budget. So we've worked out sales receipts to be 20,900, materials cash outflows 6,400, labour cash outflow 9,500, other costs cash outflow 3,450. If we add all of those together, it comes to 19,350. And if we subtract off 19,350 from sales receipts of 20,900, we can see we have a positive cash inflow of 1,550. This activity enables you to pull together a cash flow forecast based on operating budget data and assumptions on the statement of financial position. You need to enter receipts and payments as positive figures, and if you generate a net cash outflow once you've completed the cash flow forecast, you need to enter that as a negative, either using a minus sign or some brackets. Either will be fine. Remember, follow that instruction very carefully in your task so as to achieve full marks. I'd like you to have a go at that task. Pause the recording as you work through it, or once you've got an answer together, resume the recording. So our statement of financial position assumptions are that we're going to have a decrease of receivables by £2,300, an increase of material payables of £1,400, that labour costs are going to be paid in the period in which they're incurred, and that we're going to have a decrease of other payables by £900. We need to combine the information of those statements of financial position assumptions with the data given to us on the operating budget in the table above to work out what the cash effect is going to be. So if we're going to decrease our receivables by £2,300, it means that we would have paid, or rather we would have received in more cash from our customers than is stated in the sales revenue figure in the operating budget. They've given us £2,300 more than we would have stated as revenue. So that's going to increase our cash flow. So the cash received from sales, we're going to take our £43,250 from our operating budget, and we're going to add on the 2,300 additional cash that we've received in from our customers. So my sales receipt cash flow is going to be £45,550. With our material payables, well, they're going up by £1,400, and it means that for materials, the business has not yet paid the supplier, and that's going to generate a lower cash outflow for the business than is stated on the materials line on our operating budget. So our operating budget has a cost of £12,500, and we're going to pay out less than that as a cash outflow. So we're going to subtract off that decrease in materials payables of £1,400 to generate a cash flow from materials of £11,100. Labour is the easiest one to deal with because labour is going to be paid in the period in which it's incurred. On our operating budget, our labour cost is £15,000, and because we're going to pay that within the period, it's not going to be the same cash outflow. So our labour cash outflow is £15,000. For the other costs, well, the other payables themselves are going to decrease by £900. And that means because we're decreasing the payable, it means that we're paying over more cash to our suppliers. So that's going to increase the cash outflow from the business, and therefore the cash outflow is going to be higher than the other costs that we've recorded on our operating budget of £4,250. So my cash flow from other costs will take the £4,250 from the operating budget, and we're going to add on £900 that represents the decrease in the other payables. So my cash outflow from other costs is £5,150. My total cash outflow, if we add together materials, labour and other costs cash outflow, is £31,250. And then if we subtract £31,250 away from the cash inflow of £45,550, it means we end up with a positive cash flow of £14,300. Through our first approach of putting together a cash budget, we can see that the time periods when we receive the cash or pay the cash can be different to the time periods where we record the cost or the revenue in our operating budget. And the reason for that is because of time lags. So a time lag is the difference in time between when we record the cost or record the revenue to when we actually receive in the cash or pay the cash. Now, the nature of the transaction dictates when we're actually going to receive or pay the cash. If we have a cash transaction, such as a cash sale, well, we're going to receive the cash at the time of the sale. There is no time delay. You can imagine if you're in a shop, then you're making a cash sale, you hand the goods over to the customer, and the customer gives you the cash immediately, so it's an immediate transaction and there's no time delay. However, there are situations in most organizations where we are giving our customers some credit, or we are receiving some credit from our suppliers. So if we do have credit sales or credit purchases, receipt or payments of the cost or the sale occurs at a time after the sale or the purchase is made, and therefore there's a time lag between the sale or the purchase and the receipt or the payment of the money. Now, when we're putting together a cash budget, we will need to take into account all of those time lags. We do that by making assumptions about what that time lag is based on the average credit taken by our customers or average credits that we take from our suppliers. Let's consider how a cash budget can be put together taking account of time lags through illustration 3. So we have here a division of SC Fuel and Glass. They're preparing their quarterly cash flow forecast for October, November and December. Now we've got sales of the division expected to be £680,000 in October, £700,000 in November and £750,000 in December. We expect that 20% of those sales are cash sales, meaning that the cash is received in as the sale is made, so it's received immediately, with the remainder being credit sales. We've done some analysis of our previous sales pattern, and we can see that customers on average, 20% of them pay us the month after sale, 50% of us pay us 2 months after sale, and 30% of customers pay us 3 months after sale, which therefore means the cash for October, for example, will be received in 3 months following October, 20% in November, 50% in December, and 30% in January. So when we're pulling together the cash flow forecast for the sales that we've made in October, we're going to have to take into account that receipt pattern, when the customers are likely to pay it. But that isn't the whole story. If we are pulling together, say, the cash flow forecast from October to December, then of course we'll be receiving money in from our customers from sales made in earlier months. So we're also going to have to get hold of the information about sales from those earlier months to put together an accurate cash flow forecast for sales from October to December. So we're giving that underneath. We've been given the total sales in July and September for the fuel division, £600,000 in July, £560,000 in August, and £620,000 in September. So now we've got all of the information we need, we can start to put together the budget or the cash budget from sales for October to December. The easiest starting point is to work out the cash sales that we have made in each of those months. Because, of course, as I said earlier, we're going to receive the cash the moment we make the sale. Remember that we have 20% of monthly sales that have been made as cash sales. So the receipts from those cash sales in October is going to be 680,000 multiplied by 20%. So from cash sales in October, we were receiving £136,000. In November, it would be 700,000 multiplied by 20%. So the cash receipts from cash sales in November is 140,000. And then in December, we would have 750,000, our total sales for the period. And again, 20% of those sales are for cash. So we would receive in cash receipts of £150,000 as cash sales from December. But of course, that isn't the whole story. We've now got to work out the pattern of the credit sales and ensure the cash received from those credit sales are going to be inserted into the cash budget in the correct months. So on this page, we're given a workings table, helping us to work out when the cash is going to be received from the credit sales in July all the way through to November. So in July, well, what we're going to have is we're going to have 30% of the credit sales outstanding, which we would then receive in October. So our July sales was 600,000. 80% of those sales will be credit. Remember, 20% are cash, so that leaves 80% as being on credit. And 30% of our credit customers pay us 2 months after the date of the sale. 2 months after the date of the sale is October. So from the July sales, in October, we will be receiving in £144,000. From the August sales, remember 50% of our customers pay us 2 months after the sale has taken place. So from the August credit sales, 50% will be outstanding and would be received in October. So from the August sales, £560,000 is our total sales. 80% of those total sales are credit sales, and 50% of those credit sales will be received in 2 months after the sale has been made. £224,000 will be received in October. Also remember that 30% of our customers pay us 3 months after the sale has been made. So 30% of those credit sales will be received in November, 134,400. In September, 20% of our customers pay us in the month following the sale. £620,000 are our total sales. 80% of those sales are credit sales, and 20% of our customers pay us the month after the sale has been made. So we're going to have £99,200 worth of those September sales in our October cash budget. 50% of those sales are received in 2 months after the sale has been made. So we're going to have £248,000 of cash receipt in November, and 30% of customers pay us 3 months after the sale has been made. So £148,800 will be received in December. In October, we made £680,000 worth of total sales, of which credit sales represent 80% of those total sales. 20% of our customers pay us the month following the sale, so we're going to have £108,800 as our cash receipt in November. And 50% of our credit customers pay us 2 months after the sale has been made. So we're going to have £272,000 in our December cash receipts. From our November sales, we're only worried about the customers that pay us the month after the sale has been made, because of course 2 months afterwards is January, and that's in the next accounting period. So our November sales, 700,000 is our total sale, 80% represents credit sales, and 20% of customers pay us the month following the sale. So £112,000 would be our cash receipt from November credit sales in December. If we add it together, our total receipts from credit customers in October is £467,200. Our total sales receipts from credit customers in November, £491,200. And our total credit receipts in December is £532,800. We then add those credit receipts to the cash receipts to find out our total receipts from sales for each of those 3 months. It's important to note that dealing with time lags in the budgeting assessment is the least common way in which cash budgets are actually assessed. So if it's something that you don't have a lot of time to try to get into your head, then it's not usually the end of the world. But on saying that, some assessment variants do present cash budgets with a time lag attached to them. So if you were asked to produce an entire cash budget with time lags attached, this is the approach that you need to take. You need to fill in any amounts paid in the period in which they're incurred, because ultimately we don't need to adjust those. So look down the information and see if there are any items where we're paying in the same period as them being incurred. Some examples of this might be things like wages and salaries, sundry expenses, and any capital payments. Once we've done that, complete the general overheads, removing non-cash items such as depreciation. So you look for general overheads. Usually with general overheads, we're going to incur them or pay them in the same period in which they're incurred. And all we need to do to adjust them is to look for any non-cash items like depreciation. So reduce them down by the non-cash items and add them into the cash budget. Next thing is to complete payments of purchases and overheads, because they tend to have 30-day credit terms or in assessment tasks. So just look for the payables and any other overheads which have those terms and pop the cash outflow into the next month. And then the final thing to do, because it's the most cumbersome thing to do, is to fill out those sales receipts last, because they're the most complicated due to differing credit terms and the split between cash and credit sales, and potentially having to deal with settlement discounts too. They tend to be the most complicated. So as I say, pulling together the entire cash budget is not very common in assessment tasks, but just in case you're asked to do it, for completeness, we've included it here, including an activity for you to have a go at. Use this activity to practice putting together a cash budget when we are dealing with time lags. So you've got over the page a table to fill out, which asks you for a monthly cash flow forecast for quarter 2, and you've got some detail about the sales, the purchases, the wages, and some information about when those sales are received in, when those purchases are made, and when the wages and other overheads are made as well. So I'd like you to work through the information and pull together a monthly cash flow forecast for quarter 2, and once you put one together, resume the recording. When putting together a cash budget when we're dealing with time lags, it's important that we do this as efficiently as possible. The best approach to this would be to deal with any items that don't have a time lag first, then deal with any items that have a time lag but should be relatively easy to work out when it's going to come in or go out, and then finally deal with items where there might be a split between cash and credit transactions, or where there's a split in terms of time periods as to when we're going to receive the cash in or pay the cash out. In this activity, the easiest item to deal with first is going to be the wages and other overheads. We're told that they are paid in the current month, meaning that they're going to be paid in the month in which we incur the expense. There is an added complication in wages and other overheads though, because within other overheads, we got depreciation of £400 each month. Depreciation doesn't have a cash transaction associated with it. It's simply an adjustment for using up an asset during the period. The cash transaction associated with the asset is actually the cash flow that we have incurred when we've purchased the asset. So when we're doing the other overheads, we've got to remember to subtract out the £400 for depreciation, which doesn't have a cash effect attached to it. The wages, on the other hand, are straightforward. We have wages every single month, and all we have to do is simply copy what's in the operating budget into the cash budget. So our wages, let me quickly move that up to the correct line. There we go, one above it. They're going to be £800 in April, £850 in May, £850 in June, and that gives us a total of £2,500 in the quarter. Okay, other overheads we can do now, but we've just got to remember to subtract off £400 every single month to account for the depreciation, which doesn't have a cash outflow associated with it. So in April, we're going to take £650 and subtract off £400. In May, £675 less £400. And in June, £675 less £400. So our other overheads in April are going to be £250, in May £275, and £275 again in June. And that gives us a total cash outflow of £800 for other overheads in quarter 2. Okay, the next easy one to deal with are going to be the purchases. It says that purchases are paid 1 month after we incur the expense. So it means that our March purchases will pay in April, our April purchases will pay in May, our May purchases will pay in June. So it's just delaying the cash flow by 1 month from when we've incurred the expense on our operating budget. So on our purchases row, we'll have £1,200 in April, which represents March's purchases, £1,300 in May, which represents April's purchases, and then £1,500 in June, which represents May's purchases. And that gives us a total cash outflow for quarter 2 of £4,000. Okay, now we get on to the awkward one, which is sales. The information tells us that we make 30% of sales for cash, and the remaining sales are credit sales, and our customers pay us 1 month later. So when we look at the sales revenue figures in the table above, we firstly got to split those figures between cash and credit sales, and then work out when the credit sales are going to be received in. So let's start with our April figures. So in April, we're going to receive some of March's sales. March's sales were 4,250. 70% of those sales represent credit sales, and we're going to receive that in April. So we will receive in £2,975 from March's sales figures in April. We're also going to receive in part of April sales figures because they are the cash sales. So our April sales are 4,600. We're going to receive in 30% of those sales. So we will be receiving in £1,380 from April sales. Let's do May. Now in May, we're going to receive the remainder of sales from April. So we had 4,600 total sales in April. £1,380 worth of those are cash sales that we would have received in April. So we're receiving the difference in May. So we're going to receive in £3,220 of April sales in May. We'll also receive in some of May's sales as well, because of course 30% of sales are cash. Our total sales in May were £5,000, and we're going to receive in 30% of those sales. So we're going to be receiving in £1,500 worth of May's sales revenue in May. June. So we're going to receive the remainder of May's sales in June. We had a total of £5,000 worth of sales, and we've already received in £1,500 worth of those sales in May. So we'll be receiving in £3,500 of sales in June. And then, of course, we're going to be receiving in June's cash sales. Our total sales in June were £5,350. 30% of those sales represent cash sales. So we'll be receiving in £1,605 from June's sales in June. So if we put that into our cash flow pro forma, we have total receipts in April of 4,355, total receipts in May of 4,720, and total receipts in June of £5,105, and that gives us £14,180 in total in quarter two, made up of £9,695 worth of cash sales and £4,485 worth of credit sales. There is one last thing we need to put onto our cash flow, and that is capital expenditure. Now, capital expenditure is one of those items that is going to be incurred within the month that we got the costs on the operating budget. We're told that we're going to incur a cost of £3,000 in May and £1,000 in June, a total of £4,000 overall. If we total up our cash payments, we got £2,250 in April, £5,425 in May, £3,625 in June. That gives us £11,300 in total cash payments, made up of £4,000 worth of purchases, £2,500 worth of wages, £800 worth of other overheads, and £4,000 worth of capital expenditure. Next, we need to work out the net cash, and that is going to be the receipts less the payments every single month. So our net cash movement in April is going to be £2,105. Our net cash movement in May is going to be negative £705. And our net cash movement in June is going to be a positive £1,480. And that gives us a total net cash movement of £2,880. Our opening cash balance in April was £750, and through April we got a positive net cash movement of £2,105. So if we add the opening balance of £750 onto the positive net cash movement of £2,105, we end up with a closing cash balance of £2,855 at the end of April, which then translates into the opening cash balance in May. The cash balance in May was negative £705. So if we take our opening cash balance of positive £2,855 and we subtract off the net cash outflow of £705, we end up with a closing cash balance at the end of May of £2,150, which once again translates into the opening cash balance in June. If we then add on the positive cash balance of £1,480 to the positive opening cash balance of £2,150, we end up with a cash balance at the end of June of £3,630. We can reconcile that by working out whether the total for the quarter is going to be the same closing balance. We have a total net cash movement of positive £2,880. We started with a positive balance of £750. So if we add 750 to 2,880, we end up with a positive cash balance overall of 3,630. Through the chapter, we've seen that when we are putting together a cash budget, we also need to include any expenses or cash outflows relating to the purchase of non-current assets. Now, the purchase of non-current assets are relatively easy to put into our cash budget because it's going to match the amount shown as an addition on the statement of financial position. We literally see what the addition is on the statement of financial position and just make sure that we haven't paid for that asset in installments. The amount overall is going to be the same. But when we've had enough, or we've used up all of that asset and we're going to get rid of it, we may be able to sell the asset. Now, on our operating statement, we're likely to see a profit or loss related to the sale of that asset. But remember, that profit or loss is not a true monetary profit or loss. It's related to either over or under depreciation of that asset when we have held it. So when we're pulling together the cash budget and we're dealing with sale of non-current assets, we need to calculate the proceeds on the sale, which is likely to be different to the profit or loss that we've stated on our statement of profit or loss. Now we can do this by finding the profit or loss that's stated on the statement of financial position, the carrying amount of the asset that has been disposed of, and finding the difference between the two. That should give us the cash proceeds from the sale of that asset. So the proceeds can be calculated by taking the carrying amount of the asset and adding on the profit, or if we've made a loss, subtracting off the loss. The total of that sum should be the proceeds that we've generated on the sale of that non-current asset. Activity 3 asks us to calculate the proceeds from the sale of machinery that we need to include into our cash budget. So we've got AC Limited, who sold machinery for a profit of £5,000, or at least that's the profit that they've recorded on their statement of profit or loss. They were carrying the non-current assets on their statement of financial position at the date of disposal at £20,000. So to calculate the proceeds from the sale of the machinery, we need to take the carrying amount of the asset, which was £20,000, and we add on the profit that we've recorded on our statements of profit or loss, which was £5,000. So my proceeds were £25,000 in total, and that's what we will put into our receipt line on our statement or on our cash budget.
Chapter 5 serves to prepare you for learning outcome number 1.3. Now that learning outcome is on types of budget. Okay, and what specifically is being addressed in this chapter is preparing cash flow forecasts. Okay.
This chapter presents two different ways in which a cash budget can be prepared. The first one is to look at timing differences and looking at the cash effect of time differences. If you have a question that focuses on timing differences when preparing cash budgets, it's important that you take a logical approach to putting together the cash budget. Look for one-off and irregular payments first. For example, the sale or purchase of non-current assets. That should be relating to just one time period, so it should be easy to just put it in. Look for regular payments with no timing effect second, because again, that should just relate to one time period. And then finally, look for any items that have timing, such as sales receipts, where we may be granting our customers 30 days credit, same with suppliers, and we might also need to take into account any settlement discount that we either receive from our suppliers or we offer to our customers. The second approach to preparing a cash budget presented in the chapter is to use both the operating budget and the statement of financial position assumptions to look at the movement in balances and therefore the cash effects of those movements. Out of the two approaches to putting together the cash budget, it's the approach using the operating budget and the statement of financial position assumptions that is the most often tested.
So in this chapter, we looked at the cash budgets or cash flow forecasts, which is a key part of the planning process, but focus very much on the cash inflows and cash outflows of an organization. Now, in putting together a cash flow forecast, okay, it is possible that you'll be called upon to put together a cash flow forecast, in which case you will be given a pro forma to fill in, okay, or more likely you'll be putting together calculations for elements of a cash flow forecast. So for instance, you might be called upon to do a working for the cash receipts from sales. Okay, now if you've got a business that makes cash sales, quite clearly the cash receipt will take place at exactly the same time as the sale. But a lot of organizations don't do cash sales. Okay, they give their customers a credit period, in which case, when you're forecasting your cash flows, you will assume a receipt from your customer sometime after the sale has taken place. Remember also that you can work out what the budgeted cash inflow from customers would be from looking at the movement in receivables in conjunction with the budgeted sales. Payments for purchases, they will behave in a very similar way to receipts from customers. Clearly, we are talking about cash outflows in this case rather than cash inflows. Okay, but yeah, some of your purchases may be for cash, in which case the cash outflow will take place at the same time as the purchase. But if your suppliers give you a credit period, then you can wait for maybe a few weeks, maybe even a few months before having to pay the supplier. Okay, and likewise, we can calculate the budgeted payments for purchases by looking at the movement in your trade payables in conjunction with your budgeted purchases, and that will allow the calculation of the purchase outflow. Okay, now when you're dealing with cash budgets or cash flow forecasts, clearly, and this is an important point because although it's a fairly basic point, it is quite easy to forget. You've got non-cash flows going through the profit and loss account. Okay, for instance, depreciation. Because that is not a cash flow, though, we would have to essentially ignore things like depreciation when putting together our cash flow forecasts. Okay. Remember that with non-current assets, the cash flows that will take place will be, first of all, when you buy the non-current asset, whenever it is that you are obliged to pay for the non-current asset, that will determine when the cash flow happens. Okay. Likewise, when you dispose of the non-current asset, you might be selling it to a new owner. Okay, and you'll have a cash inflow from that buyer.